next important service as given in your book, students, are the insurance services, and this particular service aims at removing the hindrance of risk that is prominent and inherent part of any kind of business. So let us understand the various functions of this insurance as a function of auxiliaries to trade. So CCPR, आपको ये ध्यान रखना है, CC पर, कैश क्रेडिट पर या क्रेडिट कार्ड पर, इस तरह से आप याद रखें, या क्लास पर, CC पर. तो CC पर are the letters representing the functions. Now, where C stands for certainty, it provides certainty to the business, and then again C standing for capital formation in the economy, and P standing for protection, and R is nothing but risk sharing. So now let us see from NCERT in detail that what these points has to say. So functions of insurance, CC per. Now in this first one being certainty. Now when we make insurance payments as premiums, we are actually controlling our risk. We cannot stop it altogether. The insurance cannot stop the happening of the risk, but it can definitely provide us compensation from the losses that have arisen out of that risk. So it is very, very important. So it lends us protection, no doubt, and it also removes the uncertainties from the path and giving an assured services of repayment of losses in case there is a risk by the payment of premiums. So protection is also another thing, same thing, that it helps in providing protection from the probable losses or the chances of it, which are very obvious to occur in any kind of business. Then we have C and C. Another C is for capital formation, students. Here capital formation means that accumulation of the funds, and then through premium payments, because insurance companies collect premiums from various customers, but everybody, they do not pass through a risk all at the same time. So they are collecting the premiums and ultimately they are depositing these premiums in a welfare schemes that can fetch them higher interest, so that they can also provide time to time compensations to the risk bearers in case they happen to cross through the risk. So all these systems leads to income generations in the economy, and their funds are well invested in welfare schemes that ultimately leads to capital formation and growth of any economy who are well insured. So this is also assisting in capital formation. Then we have P and R. P is for protection, as we have already discussed, compensation for the losses, and risk sharing, because there is a concept of sharing in this which is very, very prominent, because all the risk holders, they are applying for insurance on a company, and then they are all paying premiums every time without any delays. But whenever something happens, it happens only to one particular person. It's very least occurable that all persons, they get risk all of a sudden altogether. So insurance company is not on the burden to provide the compensation to each one of the risk holders, but they have to provide them with the compensation amount as and when the risk has occurred, or when the policy holder is under a exposure to the risk. So this basically leads to loss sharing by all the persons who are covered under the scheme, because every insured person is ultimately paying the premium amount. So I hope this topic of insurance functions is very, very clear. So now in this video, students, we are going to learn about the various principles that can easily be remembered as CIMF, SIP, जिसको आप ऐसे याद रख सकते हैं, कंफ्यूज्ड इन म्यूचुअल फंड और SIP. म्यूचुअल फंड करें या SIP, एक कंफ्यूजन है. सो C stands for principle of contribution, then I denoting the principle of insurable interest, M represents the principle of mitigation, F says about good faith, then S is subrogation principle, I is the principle of indemnity, and P is nothing but the principle of proximate cause. So easily remember these principles through this acronym. Now let us see, students, that what NCERT has to say with regard to these principles. Now if we say here the principle of the first one, let us take confused in. So we will start with C, the principle starting with letter C, and in this the principle with C is that of contribution. Now when we say contribution, we are supposed to take it as per NCERT, where NCERT is saying that for the same subject matter, if insurance has been taken from two different companies, then those companies are liable to contribute the loss. And let us understand with an example. First of all, NCERT is saying right of the insurer who has paid claim under an insurance to call upon liable insurers to contribute. So this is basically the principle of contribution. In case double insurance has been taken, to share the losses in proportion the amount assured by each of the insurers. So if suppose for the same car, the insurance has been taken from two companies A and B, say for rupees 2 lakh from one company and 3 lakh rupees from the other company. Now in this case, students, you can clearly see that total insurance is of rupees 5 lakh for the same cars. The matter of the insurance, the subject matter has to be same. This is very, very important. So in this case, if in case there is a loss of say 5 lakh rupees by a road accident or maybe any other cause and the car gets damaged, so in that case the insured is liable to get insurance from loss compensation from both these company A and B, and companies A and B will contribute for the loss in the ratio 2/5 and 3/5 because they have 2 lakh out of 5 lakh insurance. The total insurance is of 5 lakh and out of these 5 lakh they have 2 lakh percentage 2/5 and company B has contribution of 3/5. Now if we multiply it with the amount of actual loss, then it is nothing but 5 lakh rupees. So company A will be giving in that case 2 lakh rupees and company B will give 3 lakh rupees, and this is how this total loss of 5 lakh will be compensated by both company A and B according to the principle of contribution. So this we have seen, students. Now the next principle is that of I, insurable interest, where it is said that the subject matter of insurance, whichever is the subject matter, the insured must have an insurable interest in that. Now what is insurable interest? It is nothing but financial interest, or we can call it monetary interest in the object, whichever is getting insured. Now suppose somebody has given a loan to another person. So though both the persons are not related in blood relations or in any other way, but the other person may take the insurance of the person's car or maybe the property for whom he has lent the loan. Why will he take it? Because he now has an insurable interest, the financial or monetary interest in protection of the property of the other party, because this is how he thinks that his amount will be compensated for. So in this case, any other person can also take the insurance for the property of some other person, being both the persons are connected through insurable interest between them. So this is in NCERT also they have well explained. In case of insurance of property, insurable interest of the insured in the subject matter must exist at the time of happening of such an event. So then only the insurance is taken. So this is the principle of I. Confused in? Now we have another 5 principles, mutual fund or SIP. So M stands for mitigation, the principle of mitigation, and from the very word it says that it is the duty of the insured to take reasonable steps in order to minimize the damage caused to the property or loss to the property. It cannot be so that you will just sit and watch because insurance is there. Rather, it's the duty, prime responsibility of the insured to minimize the loss as far as possible. Suppose घर में आग लग गई, फायर इंश्योरेंस आपने ले रखा है, गुड्स जल रहे हैं, तो आपको फायर ब्रिगेड को बुलाना है या फायर एक्सटिंग्विशर्स लगवाने हैं. सिर्फ आप बैठ के देख नहीं सकते कि आग लग रही है, क्योंकि हमने इंश्योरेंस ले रखा है, सब कुछ मिल जाएगा. So this is not the principle of mitigation. Now M and then comes F. With F we mean, students, that there has to be utmost good faith between the two parties. Two parties means the insured and the insurer, and this runs on the contract of ambere fide. Amberime fide. This is the Latin word which has come, where it says that they both must be in good faith with each other. Everything must be disclosed, whichever thing can hamper the decision-making power of the parties, they must be disclosed at the time of agreement. It is the duty of the insured to voluntarily make full and accurate disclosure of all facts, materials to the risk being proposed, and insurer to make clear all the terms and conditions in the contract of insurance. So let us now move to the next three principles, S, I and P, where S stands for the principle of subrogation, and it is clearly said that once it refers to the right of the insurer to stand in place of the insured after settlement of the claim as far as right of insured in respect of recovery from all alternative sources are concerned. See, in case students, there has been fire and the insured company has already compensated the loss due to fire to the goods. Now, whichever goods are left out, they are maybe they can be sold. There can be some alternative methods to sell those goods. The remains of the fire can be sold, and if that is possible, any money that can be collected on that part must be gone to the insured. It's not that insurer will have the right over that left out property. Rather, the insurer, the company will, after paying the insured, will get full right on the left out property of the after the compensation has been provided. So in this case, the insurer comes in position of the insured and he takes charge of all the leftover property, and if possible they can be sold to the market, and whatever money comes from it will directly go in the pocket of insured once the company has settled the claim of the insurer. So this is the principle of subrogation. Now I represents the principle of indemnity, where it says that any insurance contract is the contract of indemnity, means compensation for the loss, the financial loss we mean. So in this case, the only exception being the life insurance policy, because here somebody's life can never get compensated even in terms of monetary terms. So otherwise, insurer undertakes to put the insured in event of loss the same position that he occupied immediately before the happening of such an event, and definitely the insured gets back to the same financial position by the insurer as per the contract of insurance. Whatever monetary loss has happened, that is compensated. Then last principle being P, proximate cause. So here proximate cause means that the compensation will only be provided when the cause is most closer one as stated in the policy. If the policy is for fire, then the cause of loss must be fire only. If the policy is of marine insurance, then the cause of loss must be due to marine water or marine perils. So this has to be the nearest cause, the most proximate cause that is affecting the property in question. So here the proximate cause means the direct or the most dominant or most effective cause of loss. In case of this mishap is happening, then it has to be from this direct, dominant and effective cause which is well stated in the terms of the policy. So I hope all these principles are very clear. Just remember them as confused in mutual fund or SIP. So CIMF SIP. Now there is a segment, students, relating to the types of insurance in the book, where the different types can be life insurance and there can be general insurance. So you can remember as LG, life's good, LG. LG is life insurance, or it can be general insurance. Under general insurance, we have again various types: marine insurance, fire insurance and other types of insurances. So it is MFO, mutual fund organizations. So MFO, and in others we have vulgarly cattle, crops, sports or any other things like this. And in marine we have yet another types as HCF, hull insurance, C for cargo insurance, and F is for freight insurance. So these are the subtypes under marine insurance, and fire insurance is only one. So these are the various classification of insurance, students. Now let us see the common thing that has come as a question from this topic. The differences between life, marine and fire insurance, very, very important. Let us quickly discuss the differences between these three. So in life insurance, when we say life insurance, the human life is the subject matter of the insurance. In fire insurance, it's either the physical property or asset. However, in case of marine insurance, as we talked, it can be hull insurance, which means insurance relating to ship or cargo insurance, the goods in the ship, or it can be for freight insurance, that is transport expenses as far as shipment is concerned. So these three types of insurance comes under marine insurance. Now element here, it can be both the element of protection as well as investment, because life is it's very certain that the life will end up on one's or the other day. So there is also an element of investment attached to such policies, because everybody don't just invest to get the life covered, but also with an investment in mind, that it can lead to some investments if the insured person is alive for the certain period of time or till the time of the policy. So here in fire insurance, it's only the element of protection and not the investment. Again, in marine insurance, it has only the system of protection of that particular goods under cargo insurance. So insurable interest, as we talk about that, it has to be like in case of life insurance policies, the subject matter, the insurable interest must be present at the time of effecting the policy, but it is not needed when the claim falls due, because if the life is not there, we cannot expect the insurable interest to be there. But in case of fire insurance students, it must be present both the time, at the time of effecting the policy as well as when the risk falls in or the claim falls due. But here in case of marine insurance, the insurable interest, that is the pecuniary interest with the subject matter, must be there only at the time of loss, not necessary at the time of effecting the policy. So this is a major difference, very important difference between the three. And duration, the life insurance is generally for a longer duration from 5 to 30 years or maybe for the whole life of a person, but fire insurance is usually for a period of 1 year. Similarly, marine insurance is for a particular one period or maybe for one particular journey or voyage, or it can be a mixed of both. Then indemnity, as we have already discussed, the life insurance is an exception to the rule of indemnity, because anybody's life cannot be granted compensation in terms of money. But fire insurance is definitely a contract of indemnity, and the insured can claim the actual loss caused by the from the insurance company. And here in marine insurance also, it is also the contract of indemnity and can claim the market value of the ship and goods that has been destroyed by under this policy. The loss will be indemnified as per the market value of these destructions. Now, in case of loss, the next point here, the loss is not measurable, and that is why the principle of indemnity is not followed in case of life insurance principle, because loss is immeasurable. Here in both the cases, loss is measurable, whether it is fire insurance or marine insurance. As far as surrender value is concerned, students, as in this case the death is certain, so it also it may or may not happen. So, and since it is for a longer duration of 5 to 30 years or maybe till the whole life, there is a surrender value, because once the policy is surrendered, some payment is given to the policy holder. So paid up value or surrender value do exist in case of this type of insurance. However, in fire insurance, there is no surrender value. Similarly, in marine insurance also, there is no surrender value, means nothing is paid once a lapse of certain period, the 1 year period or the one voyage time is lost, and there can be no claim as well. So policy amount, here one can insure for any amount in any amount can be done for life insurance of a particular person, but here the amount of the policy cannot exceed the value of the subject matter. Subject matter may be the goods for which we are getting the insurance. From that value, the insurance amount cannot exceed. Similarly, in case of marine insurance students, the market value of ship or cargo, up to this amount only the insurance amount has to be restricted. It cannot exceed the market value of ship or cargo, because more than that will not be paid even in case of loss. Now, contingency of risk, here death is certain. So after either after the maturity of the policy or death of the person, whatever happens first, the claim will be there. But in this case, fire insurance, since the duration is very, very short of 1 year itself, the uncertainty may or may not happen.